Good afternoon. My name is Michael Thomas. I'm a second-year student at Harvard Business School, and I'm currently enrolled in the BSSE course. Throughout the semester, we've spent one day each week discussing current event topics in the news that intersect with the theories in the course. This gives us the opportunity to apply what we learn in the classroom to events in the business world as they unfold in real time. One current event that has been in the headlines recently is IBM's announcement of its agreement to buy the software and services company Red Hat for approximately $34 billion. The deal is IBM's biggest acquisition ever and is part of IBM CEO Ginni Rometty's plan to revive the tech giant by building out a cloud computing business that can compete with the likes of Amazon and Microsoft. The acquisition is IBM's latest move in its effort to transition away from older, slower growth lines of business and into new technologies like artificial intelligence and cloud computing. An interesting question to ask is whether theory has an opinion as to how IBM structures, executes, and integrates the acquisition of Red Hat. Now, we know from academic studies that the vast majority of mergers and acquisitions fail, somewhere between 70 and 90%. And yet IBM's announcement is the latest of several mega M&A deals we have seen over the past few years. The BSSE theories tell us that there are two reasons to acquire a company. The first is to boost a company's current line of business, whether that be by holding onto a premium position or by cutting costs. The second is to reinvent a company's business model and fundamentally redirect the company. In the first instance, the company leverages its business model by extracting resources from an acquired company and plugging them into the parent's business model. We call this an LBM. In the second instance, a company reinvents its business model by buying another firm's business model, operating it separately, and using it as a platform for transformational growth. We call this an RBM. Theory tells us that there's far more growth potential in purchasing another company's business model than in purchasing its resources. That is to say that RBMs are much more likely to drive transformational growth than LBMs. However, the vast majority of M&A activity we see are examples of LBMs. Time and time again, acquirers buy target businesses and integrate those assets into the parent company. There is actually economic logic behind this approach. Acquirers attempt to integrate the target's resources in such a way that scale economies can drive down costs. We call these synergies. It's particularly effective in industries where fixed costs represent a large percentage of the total cost structure. Now, traditional corporate theory suggests that the right buyer for a business, and by extension the one that can pay the highest price, is the buyer that can extract the most synergies by integrating the target business. Many of the key stakeholders in the context of M&A, particularly public company M&A, are focused on such near-term synergies. These include boards of directors, investment bankers, equity research analysts, the business media, and shareholders, especially activist-minded shareholders. The problem is that most acquirers end up overpaying for these types of acquisitions, these LBMs. Integrating business is hard work, and synergies are easy to estimate, but difficult to realize. Companies can, however, use M&A as a tool to create value and drive transformational growth, if they have the discipline to treat the acquisition as an RBM. Theory tells us that a successful M&A strategy is one in which an acquirer identifies a potentially disruptive business strategy, buys the target company in order to own and operate that business model. To execute this approach successfully, however, it's important to keep the business model intact, which most often means operating the target company separately from the parent company. But it's incredibly difficult not to cave to the traditional financial pressures calling for synergies, in particular when synergies are used to justify a large purchase price. Coming back to the case of IBM's acquisition of Red Hat, IBM appears to be treating Red Hat as an RBM. In its press release, IBM has indicated that it intends to operate Red Hat as a distinct unit in order to preserve the company's open source development heritage, its go-to-market strategy, product portfolio, and development culture. Said differently, IBM does not intend to integrate the two businesses. Instead, IBM plans to maintain Red Hat's separate headquarters, facilities, brands, and corporate practices, as well as its roughly 13,000 employees. Red Hat will continue to be led by its current CEO, who will report directly to the IBM CEO. The dilemma IBM now finds itself in comes from the fact that the company is paying a massive price in order to acquire Red Hat's business model, roughly $34 billion. The offer represents a 63% premium over Red Hat's pre-announcement share price. If IBM is successful in treating Red Hat as an RBM, it may indeed unlock transformational growth and value creation greater than this $34 billion. However, IBM is highly likely to feel tremendous pressure from the financial community to deliver synergies in order to justify such a large purchase price. Achieving these synergies would require IBM to integrate the two businesses. So the question is, how long can IBM withstand the pressure to deliver synergies? Particularly as a large publicly traded company, how long can IBM ignore pressure from its investors, its board of directors, equity research analysts, advisors, and the business media at large to integrate the two businesses? In short, can IBM defy gravity? So far, the company seems to be on the right track. The press release makes it clear that IBM intends to keep the two businesses separate, and there was no mention of synergies. But even if IBM can defy gravity, the question then becomes, for how long?